Coming up today, NVDA says it wasn't subpoenaed, why the market's vulnerable to a correction, the yield curve disinverts, what that means for stocks, more signs of weakness in the economy, oil keeps sliding, the latest prediction from Scottie Pippen, and a warning from the FBI. You don't want to miss this one, guys. Let's get it. So it kind of looks like the market's stumbling here a little bit, finishing a little lower again today. The market's probably on standby mode, waiting for the big jobs report due out this Friday morning. Could really get things moving. Still a little weak up the front, especially in risk-on growth and energy stocks, with the defensive sectors still holding up. And we've still got the VIX climbing. Higher highs, higher lows today. Actually getting above 23 briefly this morning. And stick with me today because I'm going to come back a bit later on. We're going to talk about some new signs of weakness in the US economy, along with the US 10-year government bond yield just losing support, which is not really a good sign. We're also going to be looking at oil today, diving down below $70 a barrel. However, just starting off with the biggest headline from yesterday, NVIDIA, which fell about 10% to start the week. A little bit weaker again today. After we had news yesterday, the Department of Justice apparently subpoenaed them, requesting more documents, potentially ramping up a big antitrust lawsuit, given that they pretty much run a monopoly for advanced GPUs. And this is just after we got their earnings report last week, which was highly anticipated. Market soft reaction. Ever since then, we've wiped off almost $500 billion in market cap. However, they just came out today and said they haven't been subpoenaed by the Justice Department, instead saying the DOJ sent a civil investigative demand, and they kind of pushed back a bit, said they're happy to answer any question regulators may have about their business, and their success is due to merit and customer value. The customer's free to choose any solution. However, just looking at the reaction in the market, 5-minute price chart of NVIDIA shares is warming up a little bit, not too much, not even up quite 1% in after hours as I speak. And like I said, this is important for the market, even though the market is rotating into defensive sectors. This is still the most important stock, and semis is still the leading sector of this bull market the last 2 years. So it would be significant if NVIDIA did take out $100 a share and just increases the likelihood that $140 may have been the top, and that could be a significant event for this bull market. But either way, like I've been saying, we should expect to see more volatility, not only in this seasonally volatile period, but we've also got a hot US election coming up, and the market's still unsure whether the Fed is going to cut 25 basis points or 50 basis points, which could go either way with the market's reaction. If the Fed starts anting frantically to get ahead of a quickly weakening jobs market, that may just be enough for the stock market to get worried about that and really mark down growth stocks and sectors. And it's something I've noticed in the spreads lately. High beta versus low volatility. Been quite soft here, along with growth sectors versus defensive sectors being able to reclaim their 50-day VWAP, and have actually just gone negative on the year as well. So definite rotation into defensive sectors still going on here. And we can see that once again with the staples sector breaking out to highs again today, and names like Berkshire Hathaway doing really well lately. Warren's got over a quarter of his market cap in cash, and I think that's appealing to a lot of investors who are justifiably worried about what's around the corner the next 6-12 months, pending recession. Warren Buffett, as usual with Berkshire Hathaway, will be best positioned to not only withstand that storm, but take advantage of it. Given he's got about $250 billion in cash and T-bills, he can take advantage. The next time the stock market's on sale, and you can pretty much think of Berkshire as an ETF focused on American domestic companies that are very well run, and the managers and the board don't loot the company like you see with a lot of other stocks. The most famous coming to mind when I say that being Snap. Management and the board, I think they've actually paid themselves more than what the actual market cap is right now, $14 billion, with the company never turning a yearly profit. So they're kind of destroyers of capital for shareholders, whereas Berkshire Hathaway always acts in the best interest of shareholders. And this is on top of the financial sector in general, doing really well, along with utilities. And we can see they're looking a lot different, consumer discretionary. So big money could very well be preparing for a recession around the corner, reshuffling portfolios into more defensive names. And like I said, I'll be watching the price action, not only in NVIDIA, but semiconductors to kind of confirm that theme playing out if we see semis take out some key support levels. However, not everybody's given up. Ed Yardeni says the stock market will be volatile until the election before resuming its rally to record highs. He also believes gridlock in Congress will be the best result for the market to achieve new highs, as that minimizes uncertainty and legislative surprise. And just looking at a seasonality chart here of the S&P 500, right where we are now, the start of September, going into the election, like I said, we should expect a bit of a roller coaster ride, up and down, if not further correction and weakness going into early November. And I think this article summarizes sentiment out there pretty well. Investors are in a love-hate relationship with the stock market. It's hard to allocate assets when everything has done great, yet nothing seems worth buying. And so it's true, isn't it? Tech has been crushing it. Their growth rates, their margin, capex, pricing power. However, they're not exactly cheap. They've had such a good run, and it may just be a case of it being not a great time to buy tech stocks, although I wouldn't want to short them either. Also interesting to see discount department stores getting hammered after we saw Dollar General last week get slammed. Same thing happened again today with Dollar Tree. With it being reported, even middle-income consumers are pulling back, getting hit hard today on worse than expected results, reporting that consumers are hosting fewer and smaller parties, with their same-store sales only growing 1.3% versus the 3% that was expected. And there's a look at the daily chart. Absolutely clobbered here, down 22% today. However, just looking at my fundamental chart, revenue has still been increasing over the last couple of years. My stock fair value indicator has it about $92 a share. And so just like Dollar General, this could be setting up a contrarian play, given these shares are pretty much on sale now. And if we do go into a recession, a lot of consumers will be coming back to these dollar stores to do their shopping, and they can quite often hold up well during a recession compared to other stocks out there. And that was actually the case for Dollar Tree back in the last bad recession the US economy had in 2008. US stock market fell over 55% from its highs in 2007 into March 2009. And whilst Dollar Tree had a little bit of weakness coming into 2008, it completely diverged from the stock market, actually finished 2008 higher, which was one of the very few well-known stocks to do so. And so I'm not saying we've bottomed here. Given this large push down, wouldn't be surprised to see it trade in the 50s over the coming weeks. Like I said, that could be a contrarian play and a little bit of a hedge on the recession, because it's still a profitable business, and they did report 67 cents in earnings per share today. However, a big event in financial markets today was the US yield curve disinverting on the back of some soft economic data today. And I touched on this last week as it was pretty much at break even, right on the verge. However, it did uninvert today, the 10-year and the 2-year, otherwise known as a bull steepening in the bond market. And that's because it's bullish for bonds. You got short-term rates falling faster than long-term rates. Market indicating the Fed needs to start cutting rates quickly because the economy is weakening here and now, and thus long-term rates don't weaken as much. That's typically what you see going into a recession or economic weakness. Then out of that, we get a bit of bull flattening into a bear steepening, which is typically at a bottom. The market then prices in again growth and inflation, and short-term rates start climbing again. And so it's interesting this time. We've had the longest inversion on record, 544 consecutive trading days. Something we quite haven't seen since the late 1920s, before the US economy was plunged not only into a recession, but into a depression, with the difference between the two coming down to the severity of the economic contraction. Recessions typically last 2, 3, 4 quarters. Depressions can go on for years, see a much larger spike in the unemployment rate, like in the 1930s. A quarter of all Americans were unemployed. However, the thing with macro you got to remember, it takes a long time to play out. Months, sometimes years. And I'd say since we've been inverted for so long, maybe this uninversion process and the start of a recession could take longer as well, because stocks can quite often finish higher 12 months later after the uninversion. And there's a look at the yield curve today, just creeping back into positive territory. And that's on the back of the beige book, with 2/3 of Fed districts reporting flat or declining activity. Employment levels holding steady, but consumer spending decreasing across most districts, workers getting reduced hours, manufacturing declining, mixed residential construction and real estate activity, softer home sales. We've seen a bit of a drop-off in job openings for the construction sector, and we also heard today US job openings declining to the lowest level since January 2021. And just another sign that the labour market is softening for sure. There's no doubt about it, and we can see that in this chart here of the amount of job openings in the States in a steady decline after peaking out in early 2022. However, it will be interesting to get the jobs report this Friday, because that 4.3% unemployment print we got last month may have been inflated due to Hurricane Beryl and a record amount of people unable to work, which does play into jobs data. And that's why we've got the expectation it's going to come back a little bit to 4.2%. I wouldn't be surprised if we get a 4.1 print. Be very surprised if the Bureau of Labor Statistics was going to hand us a 4.4 or 4.5 right in front of the election. The bond market's certainly not pricing that in. We even got Bank of America expecting the US economy to have added 200,000 new jobs in the month of August, which wouldn't be a bad print at all. And we don't want this to be too hot either. If the unemployment does come in at 4% or more than 200,000 new jobs created, we're going to see a sharp repricing in the bond market, potentially with stocks as well. However, I'd agree with the sentiment from this article that the US job market is guilty until proven innocent. The pickup in layoffs coupled with a low hiring rate is pointing to increased vulnerabilities for the American worker. The job market isn't terrible, but it's vulnerable. And that's pretty much what I think as well. This latest data, it is definitely becoming more vulnerable, kind of setting up the ingredient for a recession. Still possible to have a continued soft landing, however the risks are increasing. But just keep in mind we have a few key differences as usual between now and previous instances of this same setup, with a big factor now, the record immigration into the States. And so over the last 3 years, the current US government largely lost control, whether by accident or not, of the US southern border, seen a record influx of approximately 12 million illegals into the States. Not only a record for America. Also think they broke a global record for the amount of illegal immigrants crossing one country's border in 3 years, and how that affects the jobs market, as a lot of them are not counted in official numbers. So a rise in the unemployment rate of official reported workers in the insurance system may be masking a lot of the illegals coming in and taking more and more jobs inside the country as well. Either way, it muddies the picture and reporting a lot. It makes it harder to determine the real picture of the US jobs market. But one thing's for sure, we are definitely at the start of a global monetary policy easing cycle. We saw that again today with the Bank of Canada cutting for the third time in a row, bringing down its overnight rate to 4.25%, noting good progress on inflation, seeing a little bit of weakness out in the economy, and this is pretty much what we're seeing around the world. Most developed nations pulling back their interest rates or indicating they're about to, going against the grain. Japan here in the green, causing the pressure on the yen carry trade, and almost last to act the states. And just for some historical context of cutting cycles, looking at the G10 and 74 cutting cycles in the past. The average length of them only goes on for 8 months, and the average depth of total cuts, 1.55%. Not that much at all. However, it's guaranteed Jay Powell will start cutting rates in 2 weeks from now. Latest inflation reading from Trueflation, 1.24% at a yearly low, and with the moves we've been seeing in crude and commodities, it's just helped to really bring inflation down, allow the Fed to cut rates, whilst the jobs market hasn't completely exploded yet, kind of being one of the best outcomes Jay could have hoped for. Signs of a soft landing, with a chance for it to persist. And like I said, the dive in oil, which has actually conveniently happened at the perfect time. Over the last couple of months, the Fed been on edge whether it can start cutting rates or not. Also going into the federal election, helping to bring down the price of gas for consumers. This market pretty much completely ignoring elevated geopolitical tensions in Ukraine, Israel, the Red Sea, Turkey looking to switch sides from NATO to BRICS, stock market, oil, everything except pretty much gold, not really caring what's going on in the global picture. All of that's certainly a threat to the US dollar. Fact is, the world's just pumping it out, and the rebound in the Chinese economy hasn't been that great either. And OPEC, who had been trying to extend production cuts to maintain price level, kind of $80, $85 is a sweet spot for them to maximize their profits, while still keeping competing energy sources at bay. If oil goes over $100 a barrel, starts making everything else look a little cheaper. They don't want to see oil go down into $60 a barrel. And once again, we've got people on really opposite sides on the future for oil. Got the famous Dr. Doom economist Nouriel Roubini saying the world could see a 70s-style oil shock amid deepening conflict in the Middle East, like we saw back in the 70s, saying it could lead to a stagflation crisis. However, we'd have to see actual material blockages of the supply coming out from that region, which still exports about a third of its oil to the West. Then on the other hand, we've got Goldman Sachs saying AI could weigh down oil prices in the next decade, because AI can enhance logistics and productivity in oil production. A lot of AI-driven automation could cut oil production costs significantly. Not to mention the electrification of the world, rise of EVs, the rise of clean energy. Just kind of hard to say, isn't it? If I were to guess, I'd say oil's going to trade between $60 and $90 a barrel for a long time. The world obviously still needs it for decades to come. However, you can't ignore the electrification. AI will help improve productivity in all industries, including oil production, and the drive by a lot of countries and governments to get onto clean energy has to keep downside pressure on its demand as well. But if it ever got too cheap, say below $50 a barrel, then it's just going to make clean energy look real expensive. And at the end of the day, most of the market just goes to wherever things can be produced for the cheapest. And there's a look at the daily in crude oil, now testing support from December last year in the high $60 a barrel. And this has typically been a time when we've seen Warren Buffett top up on his favorite bets as well, like an Oxy. Every time we dipped down to this level last year, we'd get news out a few weeks later. Buffett bought the dip and added to his position. So it'll be interesting to see whether he's going to continue buying the dip on oil here in some of his favorite names. Moving on to gold, got an interesting article out today with one market veteran saying gold's rally could face the wrath of God as Fed cuts rates. That's Jim Paulson, predicting gold's rally might end due to fading recession fears and current high prices. Gold's outperforming the stock market so far this year, and he's saying gold might not benefit from Fed rate cuts and lose its appeal as private sector confidence rises. He's anticipating that the soft landing will continue, reducing gold's attractiveness, and he's skeptical of a continued weak dollar and central bank buying as well. And who knows, Jim Paulson may have a point, at least in the short medium term. However, I agree with JP Morgan, founder of America's largest bank, and what he said over 110 years ago, which has even more weight, given the guy created a bank, is that gold is money, everything else is credit. And you can imagine what he would say now, after 1971, when the US dollar was no longer backed by gold. And there's a look at the daily chart of gold, still just hanging around all-time highs here, above $2,500 an ounce. Moving on to crypto, we've got famous ex-NBA star Scottie Pippen from the Chicago Bulls, posted on X today, Satoshi Nakamoto visited me in my dream last night and predicted that Bitcoin would be at $84,650 on November 5th, 2024. Not financial advice. Coming out with a very specific price target that he got in his dream by the US federal election. Appears to be he's also coming out with his own crypto coin, Bull. Who knows, maybe the future currency we're all using. But I'm not going to say he could be wrong. We could be potentially getting a new government that's very pro-crypto. And given that the US dollar has been attacked from within and externally as well, that's bullish for Bitcoin and gold. But the thing with Bitcoin is it's much easily stolen compared to gold. If you've got gold properly stored, then someone has to actually physically come and get it from you. However, with Bitcoin and crypto, it's a bit more complicated than that. Someone finds your private keys, hacks into your wallet, wake up one morning, it's been completely emptied, like we hear about almost every week. Now we've got a warning from the FBI saying North Korea is aggressively targeting the crypto industry with well-disguised social engineering attacks, often compromising victims with sophisticated technical acumen. Not only that, they're targeting the crypto ETFs over the last several months. And wouldn't that be a crazy event? We woke up one morning to a headline, BlackRock's Bitcoin ETF has been emptied. What an absolute meltdown that would cause for the entire industry, even if part of it was emptied or made vulnerable. And that's why the old saying in crypto is, not your keys, not your Bitcoin. Proper way to store Bitcoin in crypto is cold storage in an offline hardware device. Just don't forget your password to it. And there's a look at the price of Bitcoin. Still just tracking sideways, $58,000 a coin. Got big support at 50,000 with overhead resistance at 72,000. One commodity that's been weak the last couple of months but could be finding its footing here, uranium. After last week we saw the world's biggest producer, actually responsible for 40% of global supply, coming out of Kazakhstan, Kazatomprom, lowering its production plans for next year, creating a meaningful change to the supply of the market that's already set to be in deficit for years to come. And there's a look at the Global X Uranium ETF traded in New York, which is exposed to 51 companies involved in the production and distribution of uranium. Had been holding up pretty good to start the year, has fallen off the last couple of months, but we're seeing signs of accumulation here on the chart. Now towards the bottom end of the range, could be potentially finding some support here. Got a pretty decent bullish divergence building on my DSI indicator. And so uranium doesn't trade like most commodities on a futures market. It's traded directly between producers and buyers, and the only way you can get direct exposure to the price of uranium is through the Sprott Physical Uranium Trust traded on Canada's TSX exchange, as they actually hold some uranium, and it's pretty much the only way investors to get direct exposure to the commodity. And Canada's biggest uranium company, one of the biggest in the world, Cameco, trades in New York under ticker CCJ, also showing signs of accumulation on a bullish divergence here, with not only the supply deficit and the world coming back to nuclear as part of the bull thesis, but also the explosion in electricity consumption, and that's forecast to grow. In fact, by 2050, it's projected that electricity will be 30% of the total energy consumption in the world. Big part of that, the data centers that run AI use a lot of electricity, and nuclear is the most efficient form of generating electricity. And finishing out today's data and research is the world we live in. Looking at a chart here of Europe as a percentage of the world total GDP, significantly declined over the last 20 years, even more so the market cap of Europe's stock markets. Currently around 16% of the world's stock market. And in my opinion, unless we see a real change in leadership in Europe, this chart hasn't bottomed out yet, and who knows, could go to 10%, maybe even lower. And maybe in the next 10-15 years we'll see countries like India and South Korea with bigger market caps than all of that of Europe. And there's your economic calendar for today. JOLTS job openings coming in lower than expected. Looking out till tomorrow, we've got ADP employment change, initial jobless claims, some services PMIs, GDP growth rate on Friday from the Eurozone, Canada's unemployment rate along with America's. Non-farm payrolls expected to come in at 160,000, unemployment rate 4.2%. And on the back of that weaker economic data today, we've got a little repricing in Fed fund futures, actually increasing the chances the Fed will start off with a 50 basis point cut on the 18th of this month. And so I'd previously been putting about 70% chances the Fed will cut 25 basis points. However, as always, it's a fluid situation, always dynamic with incoming data, and so I too have got to increase my chances. We'll see a 50 basis point cut. Probably at this stage, I'd give it 60-40, 60% 25 basis point cut, 40% 50 basis point cut. We see that unemployment rate come in at 4.3 again, and the amount of new jobs created comes in lower than 160, maybe 150. Say J Powell might be getting a bit anxious and might scramble to get in front of it and just start off strong with a 50 basis point cut to get things moving, which they have done in the past. So for sure the odds deserve to get stronger today, that could very well happen. But we'll take another look after the jobs report this Friday, and I'll update my odds on the back of that data as well. And just getting back to the chart, still getting a little bounce here in NVDA after hours, not too much, with the Qs coming off a little bit, along with the S&P 500. Wouldn't be expecting any too big moves in the market tomorrow ahead of jobs report on Friday, but we do have the Nasdaq underneath the 50-day, along with the Russell as well. So things are definitely a little soft here, at least up the front going into this jobs report, and we'll just see what sort of number the Bureau of Labor Statistics hands to us. Thanks very much for tuning in, and I look forward to making another video for you again tomorrow. Cheers.